Welcome to The Explainer. I'm so glad you're joining me today. We're jumping straight into the numbers to decode the 2026 outlook for Haemonetics. You probably know them by their ticker symbol, HAE. We've got a classic market paradox on our hands here. It's one of those wild scenarios where top-line revenue actually drops, but earnings, they completely surge. It's left a lot of investors scratching their heads. So we're going to unpack exactly how that happens, sticking strictly to the facts and the financials.
Okay, here's our game plan for today. We'll start with the business of blood, then look at the mixed signals in Q3, check out their FY 2027 guidance update, and finally, we'll see Wall Street's verdict.
All right, Section 1, the business of blood, what Haemonetics actually does. Just a quick refresher to set the stage before we dive into the heavy math. The really crucial thing to remember here is that Haemonetics isn't just, numbers on a spreadsheet. They're out there providing critical medical tech that genuinely enhances patient safety and hospital efficiency all over the globe. We're talking about automated apheresis, plasma collection systems, pathogen reduction technologies. Basically, these are the vital tools that blood centers and hospitals absolutely rely on every single day to manage patient care. Moving into Section 2, mixed signals in Q3. This is the financial tug-of-war. And honestly, this is where the story gets really interesting. So take a look at this. The mixed signals here are just stark. On one hand, their plasma division saw a pretty solid 3.5% bump, bringing in $138.9 million. But then, look at the blood center revenues. They took a steep dive, dropping almost 20% down to $56.6 million. Meanwhile, hospital sales were essentially flat, slipping just a tiny fraction of a percent to $143.5 million. It is a wildly uneven performance across their core segments. And this creates a truly fascinating paradox. Because of that sharp drop in the blood center unit, their overall quarterly revenue actually dipped by 2.7% to $339 million. Now, usually, when revenue shrinks, earnings take a hit right alongside it. But Haemonetics totally flipped its script. Their adjusted earnings per share jumped by an impressive 10.1%, landing at $1.31 per share. So, how on earth does a company shrink its sales but grow its profit by double digits? Well, the secret sauce is right here in their gross margin. It hit a massive 59.7% for the quarter. That is up significantly from 55.5% the prior year. That 420 basis point improvement, that's the real so what behind those rising earnings. It is absolute proof that their strategic pivot toward higher margin products and recent innovations is working beautifully. They might be selling slightly less overall volume, but man, what they are selling is vastly more profitable. In fact, operating income rose to $67.4 million, riding on the back of this exact efficiency. And CEO Chris Simon basically hit the nail on the head here. He noted that their revenue growth in specific areas, combined with his margin expansion and really strong cash flow, reflects the underlying strength of their core businesses. Management is telling us, look, yes, we have some uneven segment revenues, but our economic engine, it is pumping out cash and driving serious bottom-line value. Which brings us to Section 3, FY 2027 Guidance Update, the forecast that completely shook the stock. Okay, let's dive into this update. Haemonetics laid out their roadmap, forecasting an EPS between $5.25 and $5.30, along with $1.4 billion in total revenue. Now, from a Wall Street perspective, there were literally no massive shocks here. These numbers were pretty much dead on, with consensus estimates of $1.4 billion in revenue and an EPS of 5.29. It was just a solid, steady, down-the-middle forecast. So let me pose this to you. If the guidance perfectly met expectations, and they had just proven they could aggressively expand margins and even beat recent earnings estimates, posting $1.29 against $1.28 expectation, how do you think the market reacted to this incredibly stable news?
Well, surprisingly, the market hated it. The stock immediately slid 5.6%, down to $52.52 right after the update dropped. It's such a fascinating contrarian puzzle for us. The company does exactly what Wall Street models predict, yet the stock gets totally punished in the short term. It really forces us to wonder, were investors secretly pricing in some massive guidance raise that just didn't materialize? The tension here is just palpable. On one side, you have these incredibly strong profitability metrics. I mean, a 13.31% net margin and an exceptionally healthy 27.32% return on equity. Those are the absolute hallmarks of a highly efficient business.
But then on the flip side, you have this swift stock sell-off, fueled by totally standard inline forward guidance. The short-term market reaction just seems completely disconnected from the company's actual long-term operational health. And adding another really cool layer to this financial picture, we see an 8.27% buyback yield for the year. This is a massive signal, guys. When a company uses its cash to buy back over 8% of its own shares, it is basically screaming from the rooftops that management believes the market is undervaluing their stock. They're eating up their own equity because they see it as the absolute best return on investment out there.
So let's look at Section 4, Wall Street's verdict, the macroeconomic consensus. Let's step back from that short-term turbulence for a second and see what the pros think. Out of 11 major Wall Street analysts covering Haemonetics over the last year, the overwhelming majority are actually keeping a very positive sentiment. We've got 6 standard buys and 1 strong buy, compared to just 3 holds and only a single sell reading. It seems the institutional analysts clearly see something the reactive day traders completely missed during that post-guidance dip.
So, the crucial takeaway is comparing the current reality to that forecasted future. After that initial dip into the low 50s, the stock has clawed its way back, trading recently around $68.02. But even with that impressive recovery, Wall Street's average price target still sits significantly higher, way up at $77.11.
And that high target is exactly why the overall consensus remains a moderate buy. It implies a forecasted upside of 13.37% over the next 12 months from that $68 level. Basically, analysts are betting that this aggressive margin expansion and those share repurchases are eventually going to be fully recognized and rewarded by the broader market.
When we pull it all together for this value snapshot, you've got a medical device company with a $2.44 billion market cap, trading at a really reasonable price-to-earnings ratio of about 14.5. When you factor in high price targets reaching up to $90 a share from firms like Barrington Research, the long-term outlook looks remarkably resilient, for sure, even with those near-term revenue transitions in the blood center segment.
As we wrap up this explainer, you really have to ask yourself a critical question based on the data we've just walked through. Does Haemonetics' incredible 400-plus basis point margin expansion, combined with an 8% buyback yield and double-digit analyst upside, make this stock a hidden gem? Or do those persistent revenue dips in the blood center segment tell a cautionary tale that the market was actually right to penalize? It's a classic clash between top-line growth and bottom-line efficiency. Thanks for joining me today, and as always, keep questioning the numbers.